The stock that we're focusing on right now is KEC International, and this company has managed to post a revenue growth of about 14% in the quarter gone by. It stood at just over 5,100 crore rupees. The margins have come in at 6.3%. The net profit has risen by a healthy 53%. To talk to us about what led to this performance and what the outlook is going forward, we're joined by Vimal Kejriwal, who's a Managing Director and Chief Executive Officer of the company. Vimal, thanks so much for taking the time. Always a pleasure having you on NDTV Profit. Could you take us through what led to that 53% increase in PAT?
Good afternoon, Alex. I think the numbers are very clear as you read them out, saying that our EBITDA has gone up, our revenues have gone up, and interest costs have come down slightly. So as a combination of all these three factors, the PBT and the PAT, actually the PBT grew by 72%. PAT is we had a higher tax rate because of our Dubai operations getting taxed at 9%. Otherwise, PAT should also have been higher than the 52%.
Joining in. So the first half, if you look at your revenue growth, it has been on the healthier side. It's on the T&D business, that's the transmission distribution business, 23% growth here. But taking the other division into consideration, you've reported about a 10% growth. This is as against the guidance of 15% growth that you're seeing. So I want to understand your outlook on what is happening in the non-T&D side of the business, and are we on track to achieve our 15% growth guidance?
So our guidance for 15% has been for the full year, and I think we still maintain that we will be able to do the 15%. The first two quarters, and especially the Q2, although we grew by 14%, we could have probably grown by more than that. And I'll say two basic reasons. One is continuing labor shortage, although it's now easing out significantly. And the second one has been the more than normal, I'll say heavy rain, especially in Gujarat and Rajasthan, where most of our T&D projects. So most of the T&D projects today are linked to renewables, which are being set up in these two areas. And because of the rains, there was I think, a significant delay. So I think we are pretty okay with our guidance, and 15% should not be a problem for the whole year.
Mr. Kejriwal, Mahima this side, I want to understand that your margins in the past few quarters have remained in the range of that 6%, and what you've guided for is that your margins will go to around 7.5%. So I want to understand that how far are we from getting to that 7.5% mark, and what segments and what will be the levers that will lead to that margin growth?
So, Mahima, we are very clear that we should be able to achieve our 7.5% guidance, which we have for the whole year. Like as I said, even for the revenues will grow much more in H2. Typically, revenues in H2 are around 60% of the entire revenue. This year, I think it will be probably more, because we have done around 9,000, we're talking about 23,000. So we'll be doing around 13,500 crores in H2. Now, a couple of things which are there, which will lead to the higher margins. One is clearly our T&D business and the T&D execution is picking up and is expected to pick up much more in H2. As I said, H1 was impacted by rains, etc. Now all of that is behind us and the growth is happening. Secondly, we had a lot of order intake from international T&D, which takes some time for them to convert into revenues, etc. Now that the order intake has happened some time back, we will start seeing revenue flows coming in from international orders, which are also at a decent margin. So these are two things which are there. Thirdly, some of our civil projects and railway projects where we are not making as much money as we should have been making, those are slowly coming to an end. So the negative part of it will start coming down and the positive part will start going up. So T&D will be the major driver, but I think others will also start contributing much more than what they have contributed in H1.
That's an interesting. So tying, Vimal, all of what you've said so far, and the fact that by and large it actually kind of lends itself to the narrative that we're hearing. The first half on capex has largely been a little quiet, a little slow. It's expected to pick up in the second half, and what you're saying also lends itself to that, and you will achieve your target. But help us understand the order book. As I can see, it stood at around 34,088 crore rupees at the end of the first half. Where do we see it towards the end of the year, and what is the kind of execution that you will see over the course of the second half, and where will we end up?
So if you look at our order guidance, let's say order intake guidance, we have talked about around 25,000 crores of order intake for the full year. We have announced around 13,500. So assuming that we get the same number and we are able to maintain 25,000, so another 11,500 crores of orders would come in. Out of this 8,500, we are already L1. So I don't see a major challenge in meeting the order book target. If 11,500 come in and we have around 13,500 of balanced revenue, order book should, I'll say, remain more or less at the same levels, or maybe 1,000 crores here or there. But whatever tenders we quote now, some of them would come into our L1. So our order book plus L1 today is around 42,500. So we expect that that number should remain around that, or maybe 1,000 crores here or there.
So the order pipeline continues to be on the healthier side, but now what I want to focus is on the net debt picture. We've seen a reduction in this quarter. Would there be a further reduction in the net debt level that one should be looking at, as that would also bring down your interest cost and lead to a better profitability? So I want to understand on the net debt picture, and also improvement in the working capital cycle also, if we'll see a further improvement on that side.
So there are a few things, Anushi. One is that our net debt has gone down by around 1,050 crores or something like that. Out of that, around 850 or 870 crores was our QIP, which we did, and we got the money on 30th September. So the net debt has come down by that number. Apart from that, another 250 crores has been the reduction, despite an increase of 2,000 crores in a 12-month trailing revenues. So that's one part where the debt is going down. Interest will go down automatically because this entire money of QIP has gone into our debt reduction. So that would be a saving. As far as the net debt going down below this, I am not very sure, because of the large revenue which we have planned in H2. So because of this, I think working capital will probably go up. So I personally don't think that the absolute amount of net debt would go down. But however, today our interest cost is around 3.3% of the revenue. We do expect that for the full year, we may end up with 2.5% of the revenue. So we may have a 0.8% kicker in terms of, interest costs going down for the full year because of this debt reduction.
Fair point. Vimal, thanks so much for an engaging conversation and for sharing the outlook going forward. Wish you all the best in the second half as well.